Okay, folks, do I have a sound here?
It's on.
Hello? Excuse me? Thank you. We're going to start our next session. And I just want to remind people, at the end, there's this session, and I'll describe that in a moment. Then we have another session on kind of investment strategies and the playbook where Rich Bernstein will be with us. He's been with us before. And Marc Seidner will be the two-person panel taking questions from the audience, and we'll have a few questions for them as well. But right now, I'm going to introduce Marc Seidner, and I did that earlier. But in this role, as I said, he's a trustee of Boston College. It's Paul Romer's the Nobel laureate. His job at BC as a professor is the Seidner University Professorship. When Paul joins us in September. So we thanked Marc earlier. I want to thank him again for that tremendous gift, generous gift. And as I think we're in the talent game, and when we bring in someone like Romer, it's another big step forward for us. In this capacity, Marc works with Richard Clarida, who he'll interview via Zoom, and Marc will describe the details of Richard and all the, that. But Marc is also, he's one of the chief. You run PIMCO's alternative investments.
Close enough.
Yeah, I don't know. You're up there. Some alternative investments.
Thanks for the promotion.
I better sit down and quit while I'm ahead. Marc, it's all yours.
Call my boss. I don't know if we have. Is Rich linked up? Is he listening? Is he? There's Rich. How are you?
I'm great.
Great, good you can hear us. Let me do a quick introduction so everybody knows. Not that you really need an introduction, but I feel extraordinarily fortunate because it's not that often that I get a chance to stand between a room like this and a friend, a colleague, and a former vice chair of the Federal Reserve. Let me quickly do the bio before we get into the meat of the matter. Dr. Clarida is a managing director and PIMCO's global economic advisor, which might touch on that a little bit later. Prior to rejoining PIMCO in 2022, he was where he was the firm's global strategic advisor from 2006 to 2018. He served as the vice chairman of the Board of Governors of the Federal Reserve, and that was from 2018 to 2022. Rich is also the C. Lowell Harris Professor of Economics and International Affairs at Columbia University. I emphasize C. Lowell Harris Professor of Economics because we know that we all like to have our names used when we name things. So thanks again, Andy. Prior to 2006, he was an assistant secretary of the Treasury for Economic Policy, in which he served as a chief economic advisor for two Treasury secretaries. As I said, he's not just a friend, he's not just a colleague, but he's also a friend. And fun fact about Rich, his nephew and godson is a recent graduate of Boston College and works for the university. So there's the stronger connection. Rich, it's good to see you. I've never seen you look so large. You're like looming over me. Here I am at BC, a Jesuit Catholic university. I feel I've got an image over me that's quite powerful. But we'll get into a discussion about the economic outlook and the implications. And as you might know, Rich Bernstein and myself, after you're going to have a discussion on some of the investment implications and the outlook. But just in terms of setting the stage, I mean, maybe that we could do a show of hands, but it's probably not worthwhile. I'm not sure that too many in this room right now have ever been in the room when the Federal Reserve, when the FOMC is meeting. And again, there's obviously a lot of focus on monetary policy from the pandemic through to today. And could you just set the stage for us for a minute and just sort of describe what it's like being in the room? How does it work? And as vice chair, what do you do as vice chair?
Well, first of all, thank you, and I'm sorry I can't be there in person. It's a great event, and congratulations. Paul Romer is one of the giants in 21st century economics. So, I mean, I had not realized the Seidner professorship. Wow, we'll have to celebrate that, Mark, and we're in the same zip code. So there are a couple of different rooms that are relevant. The FOMC meets 8 times a year to make decisions on monetary policy, raising and lowering interest rates. And those meetings are pretty structured. The transcripts of them are available with a 5-year lag, and so there are a lot of courtesies, and there's a format. Maybe I talk a little bit more about the other rooms in monetary policy, because the chair sets the agenda for the committee, and there is quite an intense effort to be looking ahead several meetings, sometimes a whole year and ahead in terms of the arc of policy and having contingencies if things don't work out. And one of the privileges but responsibilities of being vice chair is that you're in that room. It's typically called the Troika, so it's a group that was set up by Ben Bernanke more formally, and then Yellen and Powell. So the Troika is the chair, the vice chair, and the president of the New York Fed. And that's a very good room to be in. It's when options are hashed out. It's when committee dynamics are assessed. I think maybe I would talk, since we have limited time, about a period that was both unusual and intense, where we had to move away from the schedule and the protocol. And that was actually during March of 2020, when very quickly the U.S. and the global economy went from a situation where COVID was a potential threat because it would shut down the Chinese economy to COVID was a global pandemic imperiling the global economy. That was a very intense period. I'll share an anecdote with the group. Jay Powell had been at a G20 meeting in the Middle East, and when he returned back, at that point in late February, there had been no confirmed community transmission of COVID. There were a handful of cases, but they were all from folks who'd been on cruise ships or whatever. And so this was still at the point of contingency planning, but Jay called a small meeting with myself and the senior staff at the Fed, and they basically laid out a couple of different scenarios for what it could mean for the economic outlook. And so Jay turned to me and said, so Rich, worst case scenario is the global financial crisis. And when I was thinking with Pete, I said, no, Chair Powell, the worst case scenario is the Great Depression. And there was a pause in the room, but I wasn't saying that just to be provocative, but the reality was we did face a scenario with lockdowns, with shutdowns, with people who weren't locked down, just choosing not to go outside because they didn't want to die going to the supermarket. And just ask yourself, think about how does a financial system work if companies have no revenues, they can't make coupon payments, they can't pay their workers? Do you just allow a financial system to collapse through no fault of company's own because there is no economic activity? So we very quickly went into whatever it takes mode, and all those meetings were done, conference calls, videos, random conversations in the hallway. It was an intense period. Mark, I don't call it the global pandemic crisis because I think that with both monetary and fiscal policy, we avoided an economic crisis. We had a public health catastrophe, but I call it the global pandemic collapse. We had a collapse in the economy. 22 million people lost their jobs in 2 months, and the economy collapsed at a 30% pace. So yes, that was one that was sort of out of the ordinary, but I think we got it right.
I mean, a lot of people say that the policy response actually wasn't sort of normal cyclical monetary policy, but it was actually disaster relief, and I guess that's what you're sort of alluding to.
Yes.
Let's turn and talk about sort of current events. Maybe we get your take on the economic outlook. But clearly, come March, a series of pretty significant collapses in financial institutions, regional banks, and then obviously the resolution of Credit Suisse very rapidly and very quickly over a weekend. The economy is also stressing and straining, and relatedly to an historically rapid pace of central bank and Federal Reserve tightening. I mean, 500 basis points, 5 percentage points in the course of basically 12 months. How do you think about the economic outlook in light of tightened financial conditions, sort of concerns about financial institutions, the potential for credit crunch, the pace of tightening that we've seen thus far?
Well, I think first of all, we have to go back just a year ago was when the Fed first lifted off in March of 2022. Um, and I think if I were to fault the Powell Fed last year, and I've said this obviously to our team in interviews, I do think there was a missed opportunity because in March, when they did the first rate hike in March of 22, they were actually pretty relaxed about what it would take to get inflation down towards target. They laid out a scenario where the funds rate, the interest rate never got above 3%, the unemployment rate never got above 4%, and GDP growth never fell below potential. And yet in their projection, inflation was around 2 by the end of 2023. So I think I've referred to that as the immaculate disinflation. But Jay Powell, to his credit, I think pretty quickly realized that they were at real risk of falling behind the curve. So, Mark, as you and I have discussed many times, what was challenging both for markets and the Fed last year is not only was it a rate hike cycle, but they essentially changed their reaction function in midstream. And so the March meeting, they hiked 25. At May, they hiked 50. And then off to the races, 75 basis points in June, July, September, November, a very hawkish speech at Jackson Hole. Essentially, although not using the R word, implicitly acknowledging that a recession would likely be needed to reduce inflation. So, they had to break a lot of eggs last year, but we've argued and we even more firmly believe, that they've gotten rates into restrictive territory. The plan now, I think, is to keep them in restrictive territory. If the economy either slows more sharply than they expect and inflation comes down more rapidly than they expect, they could start cutting. On the other hand, the only thing about inflation forecasts that you can say in the last 3 years is they've been consistently too low. So there is a risk that inflation proves to be stickier than they hope, in which case there could be an upside. I think they think they're done, which is important. And then finally, let's talk about the financial dislocation. So a couple points on that. First of all, in any rate hike cycle, there are going to be banks that have exposure either through loans or through securities holdings that loses value in a higher rate environment. Banks do, at some level, I teach money in banking, banks do two things. They do maturity transformation and credit transformation. And so if you're doing maturity transformation and you don't hedge and rates go up a lot, there are going to be losses. The banking system as a whole is profitable. It has enough liquidity. It has enough capital, but it's not ideally distributed in the system. And I think what this has revealed, in addition to I think some very serious and significant shortcomings, especially in bank supervision by the Fed, which they've acknowledged, it also reveals that we have really a three-tiered banking system, Mark. We have the big banks we've all heard of, and Big Six, JP Morgan, and so on. We've got about 4,200 small banks, literally community banks, like the two in my hometown of here in Illinois. Virtually all of their deposits are insured. They don't really face, imminent bank run risk. But we do have about a dozen or 15 or so banks in that middle category, which in the U.S. is 100 to 250. And I think what is pretty clear now is, the business model for some or maybe most of those banks, is challenged in the current rate environment. And thus we've seen what we have seen with these. But, the Fed thinks that it can separate monetary policy decisions from financial stability, and they've set up a liquidity facility, and they're actually, it turns out, lending a lot of money to the FDIC. So far, this looks to be stabilizing, but obviously there's a risk case where it could get worse, and we in the Fed will be paying attention to that.
Rich, part you said that the Fed would like to think and probably is on pause, and I just want to talk a little about the inflation outlook. Obviously, as you said, the rate moves from here on out will be solely dependent upon the outlook of inflation. The battle that's been established has been team transitory versus team persistent, and clearly team persistent has been carrying the flag for much of the last 6 months. Where are you in the battle? Maybe it's overly simplifying about the battle between team transitory and team persistent.
Well, I will confess I was a charter member of Team Transitory when we included that in the FOMC statement in March of 2021. I will confess, Mark, at the time, we didn't think it was that big a deal because at the same time in our projections, we were projecting that inflation for 2021 would fall down to about 2.1%. So I just felt that our statement was essentially acknowledging what was in our projection, that we expected inflation to be transitory. I'd say through about the first 6 months of the year, the evidence coming in was consistent with that. Inflation was above target, but it was really narrowly based. Indeed, I think at one point, almost all of the inflation overshoot was in used car prices. And, I and my colleagues weren't prepared to raise rates and throw people out of work because used car prices went up. But by the fall of 2021, certainly by the September meeting, the inflation data had turned much worse, and the inflation pressures were much more broad based. I think fundamentally, what you can say without any real questioning is, the Fed got aggregate supply wrong in the economy, in the simple sense that the broad-based inflation began to take off when the unemployment rate was above 5%. You go back to January 2020, we had an unemployment rate of 3.5%, and we had 2% inflation. So there was a big change in the post-pandemic labor market. And then more broadly, not just because of supply chains, but other considerations, the economy's ability to produce GDP without inflation was impaired. So we had a big pickup in inflation with the level of GDP about 2 percentage points below the current estimate of potential. So I think the Fed clearly got aggregate supply wrong. Misery loves company. If you read the central bank reports from the UK, the Eurozone, most of the advanced economies, what you'll see consistently is all of us got aggregate supply wrong. There's just something about the post-pandemic global economy that makes it less elastic and that makes it, have these supply-driven inflationary pressures. The final thing I need to say, and honesty compels me to say, that given that we got, and other central banks got aggregate supply wrong, then aggregate demand was also out of line. But in the US, not only because rates were low, but also because we had a huge fiscal support. In the US, we had 26% of GDP in fiscal policy stimulus enacted between March of 20 and March in 2021. So I think there's a fiscal as well as monetary and supply element. Anyway, those days are gone. The Powell Fed knows that inflation is persistent and it's going to do what it thinks it needs to do to get it back down towards 2%.
Yeah, I mean, the interplay between monetary policy and fiscal policy oftentimes seems to get overlooked with it seems like excessive blame placed on monetary policy. But as you know, who've done the cross-sectional analysis, if you can almost fit a perfect line of post-pandemic versus pre-pandemic inflation relative to or relative to fiscal response during the pandemic. And so, I mean, you could draw a logical conclusion that it's as much, if not more, about fiscal policy than it is about monetary policy.
Agree. Yeah.
Rich, talk a little bit about, so put some numbers on it, or maybe you'll dodge it and not put numbers on it, but let's try to put numbers on it. Your thoughts on the economic outlook for the U.S. You said the Federal Reserve is almost trying to engineer a recession. And as we've said oftentimes, and you've said, getting from 8% to 4% is a lot easier than getting from 4% back to 2% inflation. And so what do you think in terms of the recession probabilities and perhaps even the severity of the next downturn? I mean, many are anticipating a recession in 2023. This might be the most anticipated recession in the history of economic forecasting. And so just curious what your thoughts are on that front.
Yeah, well, certainly if we do get a recession, it will be the most widely forecasted recession. I think a couple points on that, Mark. Recession continues to be our baseline, but I always like to convey that no two recessions are the same, and we want to avoid what we call at PIMCO. We spend a lot of time these days on our biases as investors and forecasters, and we want to avoid recency bias in the following sense: the two most recent recessions in 2008 and 2020 were in some ways really unusual and atypical. They were very severe, and you had a global financial crisis in '08, and you had a global pandemic collapse in 2020. But most recessions don't look like 2020 or '08. They look like 2001 or 1990. In both of those recessions, GDP growth for the calendar year was actually slightly positive. So you can have a year's worth of growth that's positive, even though there might be a couple of quarters that are negative. In those recessions, the unemployment rate during the recession rose by about a point and a quarter, point and a half. So what I say to my colleagues at PIMCO is that if a year from now we look back and we see that in 23, GDP growth was positive and the unemployment rate was somewhere in the fours, I call that a soft landing, but technically that's probably going to be a recession because in the past, the NBER, which is the arbiter of recessions, located right up in Cambridge, Massachusetts, not too far from you all today, the NBER has never failed to call a recession when the unemployment rate rises by more than 0.5%. So I think at PIMCO we focus less on recession or no recession, on trying to get a sense of how severe, how deep it would be, and obviously what sectors would be impaired relative to others.
Well, and what's your best guess on inflation by the end of this year?
Well, unfortunately, it's stickier than I would have thought maybe in December. I think the Fed's preferred measure is the PCE price index. And I think somewhere to 3.25 or so on that index on a year-over-year basis. The CPI could be somewhat higher. Now, the other thing that we talk a lot about is what's the end game for this? And I think, in my mind, the practical end game is what I've called the 2-point something destination. So, and getting back to your earlier point that our chief economist Tiffany Wilding is very, very effectively makes, it is going to be easier to get from 8 to 4 than 4 to 2. I do think it's important for them to get to 2 point something. So I don't see the Powell Fed declaring victory with inflation in the threes, let alone fours. But if a year from now, in the first quarter of 2024, inflation's running at 2.7, 2.6, 2.8, I think that that point, if not before, they could start dialing back the level of rates, that is rate cuts, not so much that they're declaring victory, but that they've done a lot of tightening, and they don't want policy to further tighten as inflation falls. So we may be seeing a return, Mark, to something that was very topical 30 years ago, which is what economists called opportunistic disinflation. That is, you want inflation to be lower, but instead of hammering the economy to get out that last half a point or so, you just keep within sneezing distance of 2, and then in the next recession, you hope that it falls down there. So we could be seeing an element of that as well.
Rich, what's the difference between opportunistic disinflation and FATE, flexible average inflation targeting? Or is it sort of the same thing with a refresh based upon bad PR for FATE?
Yeah, well, at its essence, flexible average inflation targeting was essentially saying that the Fed, especially when rates have been zero and been constrained by the zero bound, as we saw following the global pandemic collapse and we saw the global financial crisis, at its essence, what FATE says is that the Fed would actually like inflation to average 2% over time, and so it doesn't want 2% to be a ceiling. Think of a world where in a recession, inflation falls to 1, and in a recovery, you're so good that it never goes above 2. Well, that's okay, but then you can't say you want to average 2% over time, right? So there's a concern. Now, again, it may be quaint. Maybe the world post-pandemic will look different. A very insightful question, Mark. I can see why you're an honors econ major, because implicitly an element of FATE, I would argue, actually has an implicit opportunistic disinflation piece to it, in the sense that if you're approaching 2% from above, as the Fed, the ECB, the Bank of England, virtually every central bank in the world except Switzerland. Actually, Switzerland's above target. They're at 2.1%. They're really losing their sleep over there because they overshot by 1/10 of a point. But everybody else will be approaching their target from above. And one way to try to make that credible is and to avoid having to tighten to get out that last mile of inflation is simply to say, look, we don't know when it will be, but in the next recession, inflation will fall. So, that would be a good PIMCO.com piece. Maybe we can write one about that someday. But yeah.
I'll get the byline. Andy, by the way, Rich, thanks for the upgrade to my diploma. Andy, could you go pencil that in? I mean, it's got to be in a vault somewhere. I thought it was. Come on, give me a break. Anyway, if I wasn't, go pencil it in. Rich, you mentioned 2022 being a challenging year for investors and for the Fed, and partly because the reaction function changed. Is that a temporary change to the reaction function? I mean, we talked about this a little bit last week. The mode for monetary policy, at least, the Greenspan Fed, the Bernanke Fed, the Yellen Fed, was to respond to crisis very, very quickly by cutting interest rates, and in the last two cycles engage in quantitative easing and other asset purchase programs or ways of maintaining market integrity, and then maintaining extraordinarily low levels of interest rates for an extraordinarily long period of time through forward guidance and sort of the manipulation is not the right word, but the messaging to markets,
Yeah.
and then walking up a very slow staircase. Do you think that's changed? Is there enough of a concern about overreacting and overstaying and under responding that central banks will be slower to respond to the next crisis, maybe not as aggressive? And I guess an add-on question to that is, what's the future of quantitative easing?
Yeah. Absolutely. I think all those are potentially in play. So just to go down the list. So I think staying, if rates get cut to zero in the next downturn, the appetite and in some quarters enthusiasm for lower for longer, I think will diminish. I think the idea that you go, what is it, go up the stairs and down the elevator or whatever. Um, I think Powell's broken that glass. Now the caveat is, I think the reason they had to break that glass is that they either did or were really at the risk of falling behind the curve. So I think on the one hand, I would hope that in the next cycle, circumstances would be such that the liftoff would be less behind the curve, in which case it might not be needed. But with that proviso, yes, I think that, and just speaking of my own experience during my term as vice chair, I certainly, and I think most of my colleagues, were always very cognizant, especially in communication, of learning the lessons and drawing on the experiences of prior Feds, especially in the domain of forward guidance and QE. And so the fact that the Powell Fed has broken the glass in terms of going 25 a meeting, which it did last year, and potentially also QE, I think will influence the way that future committees think about the toolkit. I wrote a recent piece in The Economist on this, and the basic idea is that QE. So remember, what QE is the central bank buys 10-year government bonds, 30-year mortgages, and takes those off the market. But it pays for them not with currency, but it pays for them with bank reserves. And bank reserves today and since 2008 pay a market rate of interest. So essentially, the simplest way to think about what QE is it is an interest rate swap in which the Fed takes off some of the coupon burden of the Treasury, but it's financing it by rolling T-bills. Now, QE looks like a free lunch, and throughout most of its 15 years, it's looked like a free lunch because the Fed only does it when rates are at zero anyway. So the floating rate leg of that swap is actually quite below the coupons. But we're now seeing that the cumulative QE done by all former Feds is being financed at a floating rate, which is the T-bill rate. And there is a cost. Now, our good friend and advisor, Ben Bernanke, would remind us that there were substantial cumulative profits to QE in the first decade or so, but on a spot year by year basis, QE is has a consequence to the Treasury. So the bottom line is QE never was nor is it a free lunch so long as central banks don't buy the coupon bonds with currency. If they buy them interest earning bank reserves, then all it's doing is changing the maturity composition of the Treasury's debt. And so I would predict that in the future, the committees will be less likely to deploy QE when it's a close call, and if they do deploy it, they'll be less likely to keep it in place for a long time. So I don't want to say it's been banished from the toolkit, but it may be deployed more in different ways. The final thing I want to say, because it's important, I would distinguish between an ongoing QE program, buying 30-year mortgages or 10-year treasuries, from liquidity provision to the banking system, such as, for example, we've seen in response to SVB and Signature. That looks like it looks similar to QE in that you're lending and growing bank reserves, but that is a liquidity function which gets and will be quickly reversed, hopefully soon, once the banking system returns to a more stable footing. So I don't see central banks getting out of liquidity provision business, but they may scale back or get out of the QE business.
Rich, this is probably a yes/no question. You know my biases, but that sounds like a much more treacherous environment for investors going forward.
Well, I think it does mean at the margin there's maybe in certain scenarios there's less of a central bank put. But look, as we learned last year, what was the Powell put worth? S&P was down 15%. In fact, that gives me a chance to stand on my virtual soapbox here a little bit. I was always, both before I joined the Fed and after spending time there, I was always a little bit skeptical on sort of an overly simplistic, central bank put argument. The subtlety that I think is important is that you did see under Greenspan and Bernanke and Yellen and Powell before the pandemic a tendency in the data for the Fed to ease pretty promptly once the economy slowed, or certainly to pause rate adjustments, if there was financial turbulence. And so certainly it does look like a put. But in all those circumstances, it's not really a hard call for the Fed if the economy's slowing or risk is elevated, so long as inflation is low and close to target. The challenge for that argument last year is the problem was inflation was too damn high, as I've said. And so I think the put is way, way out of the money when central banks are fighting an inflation problem. And so, yeah, I think at the margin, unlimited and pretty routine uses of QE might be dialed back somewhat in the future.
You talked a little about the Fed's pause question about pivot. I mean, you say pause, market is saying pivot, right? Because by the end of this year, there's already 2 interest rate reductions built into the forward curve. By the end of 2024, the market's implying 2 3/4 or 3% Fed funds, which is a pretty meaningful interest rate reduction cycle. How do you square the difference between where Fed funds are, your outlook, and perhaps even the Fed's outlook for inflation, what the Fed is telling us, and what the market is doing? Is that a complete disconnect? Is it a complete suspension of reality, or is there a rational argument to support markets pricing and markets thinking?
Yeah. I'll be the dreaded two-handed economist. I think it's a little bit of both. So an important point that is useful to keep in mind when you think about comparing Fed projections with market pricing is, for peculiar reasons I won't bore you with, the Fed decided when it started publishing interest rate projections to not use projections that were the expected level of rates at a future date, but the level of rates under a most likely scenario. So technically, in statistics, you would call that a mode versus a mean. And in a world where you have symmetric distributions, it won't matter. But in the real world, oftentimes distributions are skewed, and we do see this historically. And so one way you can rationalize and say there is no disconnect is that the Fed is saying the most likely scenario is they don't cut at all this year, and the markets are saying we agree with you, but we're saying that if you do change, it's going to be a cut, not a hike. And so that would then tend to drive the forwards and the futures below the Fed path if there's a skew to the distribution. So within reason, the fact that cuts are priced in and the Feds are saying no cuts, they could be actually be agreeing on everything. It's just they're measuring a different thing. Um, I do think, however, that I haven't looked at my screen recently, but in the last several days or so, there was actually a full cut priced in for the July meeting. So that could be, you could also think about that sort of in mode versus mean space. But I guess my rule of thumb now is, a couple of cuts, or certainly a cut by the end of the year, I think is entirely consistent with the Fed's own potential thinking that, if they do anything by the end of the year, it would be a cut. I would say that as we start moving into 25 in July, 25 in September, 25 in November, there is something of a disconnect. Again, the Fed is open to cutting rates because it does think rates are restrictive. And so if inflation does fall faster and sooner than the Fed expects, then they wouldn't be unhappy to cut rates. I would also say that if we get a sharper downturn and a bigger and quicker rise in unemployment, I could see the Fed reacting simply because we'll likely see a pretty big decline in inflation if you do see some softening in the labor market. So right now, I think at some level there's not a disconnect, but depending on how soon and how big those cuts come in, it could be something of a disconnect.
I mean, I'm curious about this. I mean, clearly, even in the team transitory and team persistent debate, when the Fed was raising rates last year, and let's say, got to 4%, at that point, inflation was still 8%. So a minus 4% real rate of interest. Even today, it's basically a zero real rate of interest. If you're right, and you're talking about 3.25 core PCE by the end of this year, and Fed funds are 5.25, won't it feel very restrictive? Won't that go from what has been a tightening cycle that's been very aggressive, but still relative to inflation, negative real rates to 2% real rate of interest on cash creates a really weird incentive for investors, because if you can get a 2% real rate of return on cash, why would you do anything else?
Well, and of course, that's the world we were in until the global financial crisis. Tip shields were at short maturities were around 2, and the funds rate at the last cycle, Ben's only rate hike cycle in June of '06, the funds rate was at 5.25, and PC inflation was at 2.75. So, well, I think the Fed tends to look at forward-looking measures, and so you can just look. It's measuring real rates is tricky now because inflation measures are all over the map. But if you want to think of a forward-looking measure, if you compare, say, a one-year yield to one-year inflation, either in the TIPS market or in CPI swaps, real rates are pretty healthy now. They're not, they don't look all that healthy compared to spot inflation. But compared to rolling market estimates of inflation over the holding period, they're probably 1.5% right now. So I think that's the way the Fed thinks of it.
We've been focused on the U.S., but any comment about the rest of the world?
Yeah, well, I think the one thing that one can often miss if one just stares at a Bloomberg screen or follows certain people on Twitter who I won't name, you would think that the only country in the world that has inflation above 2% is the U.S. In fact, as I mentioned, Switzerland is the poster child. They got it right. But essentially, every advanced economy now has core inflation in the 4s or 5s. In fact, I did a panel recently with someone from who's an ECB watcher who says, "Boy, that the ECB's got to, he's got to get the funds rate up to where the Fed has it." So I think that the one takeaway I would put, because it's absent or scarce in a lot of domestic reporting, is that the pandemic was a global shock. It was a global public health catastrophe. It had global implications for supply chains, and the labor market. And the reopening was a shock. And the policy support put in place by central banks and fiscal authorities was also off the charts. And so, the economists oftentimes use medical analogies, but you have a patient, in the hospital bed who's had gone through 3 or 4 big shocks, and we're working through it. But one of the symptoms of that is almost everybody has inflation a lot higher than they want it, and are trying to to run the hawkish policy to get it down in the neighborhood of the target.
How about the other big one that many focus on? How about China? Any views on China?
Yeah. Well, of course, we just heard from a lot of China folks. Mark, you and I are our colleagues. It is a fascinating time. I certainly would not pretend or think of myself as even a China watcher or an expert, but just reading, talking to people who are. Mark, there are a lot of things in play now with China that have not been in play. Some folks talking about a Cold War too. Other folks talking about it becoming a hot war vis-a-vis Taiwan. I think what's interesting economically is, China has 1.4 billion people, so it's a huge economy, but it's now a real two-sided case over what the growth trajectory is. There was just beware of the economist cover, but there was just an economist cover in the last day or two about peak China. So a lot of moving parts there. Obviously, the role in the financial system, sanctions, currency invoicing. I guess I don't have any wisdom other than to say I think vis-a-vis China, there are a lot of things that are in the mix right now. So it's worth respecting that.
Has anyone academically proven that the cover of the Economist is the perfect contrarian indicator, or is that just has it been proven, or is it just a gut feel?
I'll look for it. I'll have my RA look for it. I think there's confirmation bias on economist covers. They've done one a week for 120 years. So, there are 6,000 economist covers, and I'm sure you can find 12 or a dozen or 20 of them that and of course, as Mark knows, I did a version of that recently out in Newport Beach. So
Rich, you mentioned our secular forum, and this obviously isn't about PIMCO in any way, shape, or form, but it is interesting because it was just this week. It was Monday, Tuesday, Wednesday. We do bring in a number of interesting academics and market practitioners. I mean, we had the former central bank governor of Mexico, Alejandro Diaz de Leon, who was sort of one of your counterparts during the pandemic, during the last 4 or 5 years. And then someone like Neil Ferguson, as you sort of, not to front run your research, but as you think about and coalesce, anything interesting come out? Anything surprise you?
well, oh yeah, absolutely. Again, I'm just now starting to distill and think about the essay, so I'll just pick one. I think that this is this is a circumstance where economists oftentimes think about business cycles, recessions and booms, and they try to distinguish between that and the underlying trend in the economy. But one of the things I took away is that this looks like it could be a world for the next 5-10 years where it will be not only difficult but actually misleading to try to separate cycle from trend, and whether or not you're looking at economic data or market trends or policy trends. So I guess that would be my quick takeaway.
Rich, we only have a few minutes left, so I'll ask you a few sort of lightning round questions. But you're an acclaimed musician. I understand that Jerome Powell's an acclaimed musician. Did you guys ever put together the Federal Reserve Garage Band and jam for a while to relieve stress, or
we did indeed. When I met with Jay Powell, when in effect was a job interview in January of 2020, the way we ended the meeting was Jay said to me, my staff briefed me and said that you're a musician, a guitar player. I said, that's right. I thought, well, is this going to disqualify me? He said, I am too. So make sure you bring your guitar down when you join the Fed. And we actually did have guitars in the closets, and we would maybe 3 or 4 times in my 4 years there. But we also performed at the holiday party. So the Fed has a holiday party every December. Oh yeah, and Powell, Clarida, and then the Federal Reserve Choir. We had a backing choir of about 20. Yeah, it's cool. Yeah.
I don't know if there's any students in the room, but for the parents, for any rising stars who want to dedicate their life or dedicate themselves to a life of service and government service, what was more fun to work at, the Treasury or the Fed?
The Fed.
How do you define fun? Just out of curiosity.
Well, every day you wake up, and And the decisions that you make or the decisions that you don't make are going to have an immediate impact on the U.S. and the global economy. And that's not true in any other cabinet um, agency. So yeah, it's an awesome responsibility, but an amazing. Fed's been around for 100+ years, and it's got culture and traditions and a great career staff. So it was the honor and privilege of my career to have a chance to serve as vice chair.
What's the one thing that you're most proud of during your time at the Fed, and what's the one thing you wish you could have done that you didn't get done?
Yeah. Well, I think we got the global pandemic collapse right. I'm proud of that. I'm proud of the fact that before the pandemic, we allowed the U.S. economy to reach its full potential. Unemployment at 50-year low, inflation at 2. Our models and our critics were saying, raise rates. The economy can't operate with a 4% unemployment rate. So I'm glad that the Powell Fed was pragmatic, and we allowed the economy to get to a very good place against a lot of criticism.
What are you listening to these days?
What am I listening to? I'm a late adopter, but I finally now, after it's been around for a dozen years, just have my Apple Music on some sort of a playlist it picks for me for things that it thinks I will like, and that's good because oftentimes it's right, and I listen to music I never would anyway. So
That's great. And then lastly, you and I were lamenting the Celtics loss the other day. How'd you feel about last night? Hopefully better.
Well, yeah, absolutely. But anyway, spent a lot of happy moments in the old garden in those obstructed view seats. So absolutely.
Rich, well, you've done your nephew and godson Pierce proud today by joining us and enlightening us with your insights. Thank you very, very much for your time today.
Thank you all. Have a good rest of the